Hey traders, welcome back to another video of Trade Empire. Today in this video, we will dive deep into one of the necessary concepts in trading. Yes, I'm talking about liquidity. So in this video, we will explain these following topics in detail. We will explain smart money manipulation methods, static liquidity, dynamic liquidity, practical liquidity patterns and examples. And finally, we will guide you that how you can save yourself from falling into smart money traps. So let's start our video after a short intro and disclaimer. Back to the video guys. Before we dive into the liquidity patterns and scenarios that frequently appear in the market, let's start with a basic introduction to smart money and liquidity, and clearly define what these terms actually mean. Imagine major financial institutions, commonly known as smart money, planning to enter a buy position on a currency pair, or any crypto coin or any stock. And to do this, they simply require a lot of sell orders in the market. Because without sellers in the market, no transaction can take place. Because we buy when someone sells. This is how system works. So sellers are essential when banks and large financial institutes wants to buy an asset. Therefore, smart money needs to trigger the stop losses orders that are already positioned in the market so they can execute their buy or sell position. It's often speculated that smart money may manipulate the market by creating scenarios that mislead traders into thinking they understand the price action. It often leads retail traders to believe they're trading in the right direction, when in reality, they're being misled. The price just hit their stop losses, and then it continue its original trend. So to save yourself from this trap, it is necessary to identify liquidity on the chart. Liquidity can be classified into two main types: dynamic liquidity and static liquidity. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the forces that drive price movement. To better understand this, let's imagine a market structure that consists of a high and a low. Like this, as I've shown an example. These highs and lows represent external liquidity, areas where stop-loss orders and pending positions are typically found. On the other side, the fair value gap formed within the range of high and low are known to be as internal liquidity. Keep in mind, price always moves between internal and external liquidity. If we take a look at this schematic figure here, it shows an upside move, sweeping the external liquidity that is formed above the previous high. And after that, price shifts its direction towards internal liquidity, indicated by this fair value gap to fill the gap left behind. And from internal liquidity, the price starts moving towards the external liquidity. And it also sweeps the liquidity above this high. And when this external liquidity has been grabbed, the price again comes back to grab the internal liquidity at this fair value gap. Now let's move on to the second type of liquidity. Static liquidity. Static liquidity is found in key zones where significant orders like stop losses or pending trades accumulate. When these orders are triggered, the market absorbs that liquidity. Here's an important point. We use liquidity sweeps as a confirmation factor. The concept is simple. The market needs liquidity to generate momentum. And if price doesn't sweep liquidity before reaching a key level, it often treats that level itself as a source of liquidity to fuel the move. Static liquidity can be found in different areas on the chart, like below or above the dynamic trend line and channels. Below equal lows and above equal highs, above swing highs and below swing lows. Below or above support and resistance areas. Near daily candlestick body or wick. So these are the main liquidity patterns we commonly see in the market. But some of these patterns are especially essential, as they are widely recognized by many pro traders. So let's now move on to the practical liquidity patterns and scenarios. Now, here's the first liquidity pattern that commonly appears in live markets. We call this equal lows and equal highs. Let's break it down step by step. When price forms internal lows at the same price level, we call that pattern equal lows. And when price forms equal highs at the same price level, we call that liquidity pattern equal highs. Equal highs and lows fall into two main categories: double bottom or double top, triple bottom or triple top, each with unique implications for how liquidity is formed and targeted. Now let's dive deep into both of these categories step by step and explore the psychology behind their formation. Suppose we have a bullish structure like this. We can notice this valid break of structure. And after breaking the structure, the price fall back. But it failed to reach the demand zone, and it created this internal low. After that, a small bullish wave appear in the market, but again it fall back and created another internal low. It happened because of the lack of bullish momentum in the market, and in result, a double bottom pattern has been formed on the chart. And many chart pattern retail traders have executed their long position after identifying this double bottom pattern. And their stop loss will definitely set below these equal lows. And a lot of liquidity has been gathered below these equal lows. And after that, we can clearly see that price starts moving upward due to the buying pressure of retail traders. But as a smart money trader, we know that smart money can manipulate the market easily. Smart money often misleads traders with false setups, triggering stop losses to tap into liquidity and drive the market with added momentum. To gain deeper insight into how market manipulation unfolds, we'll start by drawing a bullish trend line that connects the recent swing lows. After drawing this trend line, we can now identify the area where trendline traders will open their short positions. After the trend line got broke, and price makes a small pullback, they thought that now the market will start moving downward. So, they will open their short positions here. And their stop loss will be above this internal high. And we can clearly notice that price respected the trend line but just a little bit. And when more trendline traders watch this price reaction, they also open their short positions here. This action resulted in the formation of a perfect buy-side liquidity pool, attracting stop losses and pending sell orders. And then we can see that price then surged upward, sweeping the buy-side liquidity resting above the internal high. And at the extreme, there's a demand zone along with a large liquidity pool created by buying retail traders' stop losses. In this scenario, price is more likely to pull back, clear the liquidity below the equal lows, touch the demand zone, and then reverse to continue in its main direction. So now, we will just wait for the price to tap into our demand zone. And after the price tapped into our demand zone, we will execute our long position with full confidence, because we know that both side liquidity has been grabbed. And now price will continue its overall bullish trend, so there's nothing to worry about. As I told earlier, the main objective of smart money is to hunt the stop losses of early retail traders. That's why we should enter the market when liquidity has been swept. Now let me show you a real chart example. So here we can see that the market is in an uptrend. And we can identify these two valid demand areas here. So, how do we know which zone is safer to trade and more likely to hold? Like we said before, a zone is only valid if there's been a liquidity sweep above or below it. So in this case, we do not have any liquidity sweep above or below this zone. But above this demand zone, we have this liquidity sweep pattern. So, I will not recommend you to trade on this zone. You should wait for the price to sweep the liquidity below these equal lows, and then execute your long position in this valid demand zone. Now let's move on to the triple bottom pattern. The triple bottom pattern is almost same as the double bottom. But the difference here is that in this pattern, price makes 3 equal lows. And when retail traders identify this pattern on the chart, they believe that the sellers are too weak to push the price lower, so they open their long position here. And they set their stop loss just below these equal lows. And by this, a lot of liquidity is gathered below these equal lows. As a smart money trader, we know that market overall direction is bullish. So this pattern is just a liquidity trap. So we will only wait for the price to sweep the liquidity and tap into our demand zone. After the liquidity got sweep, we will execute our long position with full confidence. But remember one thing, when price tap into the demand zone, do not execute blindly. Always look for any candlestick pattern, or switch to lower time frame for additional confirmations. Now let's move to equal highs. Two types of equal highs patterns forms in the market, double top and triple top. In double top pattern, we can clearly see that the market is in a downtrend. And after market created this break of structure to the downside, the price retraced back up and created this double top pattern. And a lot of liquidity gathered above this double top, consisting the stop losses of retail traders who've executed their short positions on this double top pattern. And we can see that we have an unmitigated supply zone just above this double top. So the price is more likely to retrace back into this supply zone, sweep the liquidity, and then continue moving downward. Same concept applies to the triple top pattern. The price only aims to grab the liquidity above equal highs. It can be double top or triple top. And when market grabs the liquidity above these patterns, there is no longer need to collect more liquidity. So we can execute our trade in this supply zone with full confidence. And when liquidity got grabbed, our chance of success increased. But remember one thing, if price did not sweep any liquidity before reaching our point of interest, there's more chance that price will use that zone as a source of liquidity. So guys, that's all for today. If this video has provided you some knowledge, please leave a like and subscribe the channel for more trading videos. Wish you good luck for your trading journey.